Hi everybody, welcome back to the Commercial Credit and Collections Conference. I'm Colin White from Credit Connect. Just wanted to welcome everybody back. For those who've been to our last two sessions, hopefully you've enjoyed it. We've covered trade credit and business change and credit management. They will be available to view after this event. So anybody who missed that and wants to see those sessions, have a look back on our the registration page in 24 hours. You should get an email as well. You can have a look at that. For this session, we're going to look at the threat of zombie companies and insolvency. And this will be led kindly sponsored by Begbies Traynor. So thanks to those guys. But before we go into the nitty-gritty of the event, I just wanted to put your attention to the controls for this event that you can see on the left-hand of your screen. So there's various icons you can see there. One of them contains an eye, which is the agenda. Have a look at that. That's got a link to the next session, which we will cover technology and credit management. So if you want to attend that one, register for that now if you haven't already. The second important bit here is the speech bubble icon. Please use that. That's got gives you the invitation to ask some questions to our chair and panel. So please get involved. We'd love you all to be part of that. We're also going to be flagging up some poll questions throughout. So if you can get involved with that, that'd be great as well. And what we're going to do is in the event review, cover off the event poll results, a couple of questions that we may not get through today, and general overviews with links to this event. And then we've got an icon which gives you information on the speakers, all their profiles, and also the company a little bit of information on Begbies Traynor and some web links as well. The other two icons give you that information. So get involved as much as you can. As I said, this session is going to be led by, sponsored by Begbies Traynor. I've got with me here Brendan Clarkson, who's going to chair this session. Brendan's going to introduce himself really briefly and our panelists as well, and then we'll get through the questions and take incoming questions and go from there. So Brendan, over to you.
Thanks, Colin. As Colin said, I'm Brendan Clarkson. I'm a director at Begbies Traynor. I lead our national credit services offering. I've worked within the industry for around 15, 20 years now. Very much creditor-led, supporting creditors, front-end, pre-appointment insolvency. So we've got three panelists today. I will do introductions and they will just give themselves a quick 30 seconds thereafter. So first of all, we've got Liam Bell, who's a director in the real estate disputes team at Memery Crystal. Liam, do you want to give us a quick 20 seconds?
Yeah, thanks, Brendan. So I am a director at the law firm Memery Crystal. We're a full-service corporate commercial firm based in the city. I personally specialise in property disputes, debt disputes, and insolvency, usually with a focus on retail, leisure, and hospitality.
Thanks, Liam. We've next got Adrian Hyde, who is a partner within Begbies Traynor.
Morning, everyone. I'm originally started life as a solicitor and 14 years ago jumped the fence to become an IP and do sort of all sorts of generally creditor-driven insolvency processes in the UK and other parts of the world. Based in the London office when I'm in the UK and Gibraltar office.
Thanks, Adrian. And finally, no means least, Ian Strangward, at Karndean.
Morning, everyone. I am, for all intents and purposes, your good old-fashioned trade credit manager. Worked in trade credit now for over 25 years. Started with Bulmer's Cider many years ago. I've worked in fuel, energy, motoring industries, amongst others, agriculture. So, yeah, really excited to be part of this morning.
Thanks, Ian. Guys, I'm going to head straight into it. We've only got 45 minutes. So I think the first question is, what are the elements of a zombie business? And sorry, Adrian, I'm going to pick on you first as the insolvency practitioner.
I read a really interesting article about this that was saying a zombie company is neither dead nor alive. So it's probably just washing its face, covering its interest, on its indebtedness. It's heavily indebted, but in our very low interest economy at the moment, it's not under pressure. So there's no credit crunch because there's no volatility in interest rates. There's no immediate upward pressure. And it's just kind of tying up capital, financial capital and human capital, and meandering along. It's and there are thousands and thousands of them out there with everything that's going around at the moment, with the COVID protective measures, which have just been extended now to the 30th of September. So restrictions on stat demanding and petitioning, have to be able to demonstrate that the debt that you're petitioning for is non-COVID related and the insolvency isn't related to COVID. So it's going to continue for some time.
I actually saw when Colin was publicising the event on LinkedIn, I think he got it in a nutshell where he actually explained it in terms of a new breed of zombie company, because there is undoubtedly a kind of accounting definition of what the zombie company is in terms of just servicing its debt interest. But I think your average man or woman on the street, either now or before very much longer, will probably come to understand it as a company which has been artificially propped up by these COVID support measures and the things like business rates, holidays, furlough. So I think to an extent they are companies which would have failed had they not been able to avail themselves of those support measures, and perhaps may fail once those measures are withdrawn.
I did one of these sessions a few weeks ago. I think I mentioned that you guys in our warm up about a week ago. The zombie business supposedly came from Japan in the 1990s. And I know we've been talking about, in Insolvency especially, we've been talking about zombie businesses probably for the last 15 years since 2007-8 crash. So, and obviously even before COVID, we've had the low interest rates, etc. I mean, Ian, for being a credit professional, you've got a business who's paying you or not paying you, but they're a zombie business. What do you do?
Well, it's an interesting one, this, because for us as a business, we supply into both the commercial contracting, construction sectors. Our flooring goes into various commercial premises. We also supply into people's homes. So you want Karndean in your house, you can have it, and we go through we sell through a network of retailers. Now, it's fair to say that a lot of businesses we trade with are, for want of a better word, what I would call a lifestyle company. So fathers, sons, husband, wives, that sort of arrangement. So they're either non-limited or they're limited, but with very, very little share capital, very, very little equity in the business, because that's the way they run their business. They take their money out when they make it, and they're very good. And you actually got that type of company. And how do you distinguish that? Because it's got very little equity in it. How do you distinguish that to a company that's actually struggling? So it's incredibly difficult to find that sort of line in the sand where you're dealing with a zombie business or you're dealing with a business that actually is very profitable, but they take their money out because that's how they live. So it's incredibly difficult. And for us, it's all about payments. It's all about cash. We are seeing a lot of companies, for want of a better word, running hand to mouth. So there are businesses out there who are literally saying to us, well, look, I can pay you when I finish this job, or I'll pay you when I get paid. We're struggling to pay at the moment because we're trying to get monies in, etc., etc. For a lot of these small businesses, they are struggling to get their cash in, or the cost of finance is starting to weigh on them, and they're actually using deposits because, as you know, if you go into most carpet shops or places like that, you want a bit of flooring, you pay a deposit, don't you? They're using their deposits to finance payments on stuff they bought 6 weeks ago, and so those are the ones that we're particularly mindful of in this environment. because they're effectively robbing Peter to pay Paul, because that deposit should be paying for the product they're buying from us now, not.
Liam, I guess there's two sides. Obviously, you've got the ethical side, but is that just not? Are they not? What harm are they doing? I think a lot that I've read in the last few months, and especially before this, was that zombie businesses are taking away business from good businesses.
Yeah, I dispute that to a certain degree, because you're absolutely right. I mean, at the end of the day, they're employing people, they're employing fitters, they're all self-employed, they're employing people behind the scenes in their showrooms or whatever they're doing. So, yeah, there's an argument that very much so that they are actually keeping the economy ticking. They're just not growing. These are small businesses. Most of our customers, I mean, obviously we deal with larger ones, but a lot of our smaller businesses, they are precisely that. And isn't UK PLC made up of how many millions? And so it's distinguishing that and those honest, if you like, for those that are struggling. I
think you're right, Ian, because I suppose there are two ways of looking at it. There's the micro way of looking at it, which is that these companies, by definition, they are just about paying what's falling due. They are employing people, but on a macro level, what they're not doing, of course, is reinvesting, and that feeds into the wider economy. And I read a report recently that said something like the state of the zombie company market in the UK at the moment will cost something like £42 billion a year in GDP, because you actually need that natural attrition of companies closing, freeing up the human and other resources to more agile, more profitable companies, and that's how you get your economic growth. So it's a real issue on a wider level.
You can see that with that tying up of capital in the. It's not strictly in the zombie companies, but you can see it in the furlough scheme. You've got there are a lot of businesses who are crying out for employees that they can't get because of the furlough scheme. Because there are other businesses that are keeping employees on the furlough scheme whilst it's continuing, and that is tying people up. And it's in exactly the same way that people could flourish and grow, and businesses could expand if there was more movement. The thing that I do think is interesting and is a potentially huge risk with the companies is, with the Bank of England base rate at 0.1%, everybody's saying inflationary pressures out there. You look at supply issues in the construction industry as an example. I know involved in a project, steel went up 4 times during May. And there is a lot of inflationary pressure. Bank of England base rate goes up from 0.1 to 0.2. It's 100% increase. Now, I appreciate that is not going to double everybody's interest rates, but people have kind of slumped into this zombie position as there was the gradual downward pressure on interest rates, and they've expanded their indebtedness. They can cope with the interest, and it's all working. It's not going to take much to knock it off that. And
that works as a bit of a double whammy as well, doesn't it, Adrian? Because if inflation rates go up, if interest rates go up, not only do these businesses suddenly have a greater expense to service their debt, but in the wider economy, there's less free cash. People's mortgages get more expensive, which means there's that downward pressure on these businesses just in terms of turnover as well. So they're making less and having to pay more.
Yeah.
And Liam, if you think, we're going back to what I said earlier, I've been talking about zombie businesses to credit teams, credit managers for about 9 and 10 years now. Yeah. Same conversation. And the remedy, not the remedy, but the worry was always, well, what about when interest rates go up? Well, 9 years on, after pandemic, people are saying the return of a zombie business, but zombie businesses technically have never gone away. So how do we? Well, the next question from our attendees is, how do you identify a zombie business? But we kind of mentioned already what a zombie business is, a definition, but how do you kind of See, I think that is a zombie business. How do you define that now? If you're a credit manager, what does he look at? What's his kind of characteristics of a zombie business?
I mean, I'm sure Ian, possibly Adrian, might have thoughts from an accounting point of view. I can only really comment in my capacity as dealing with property disputes and property insolvency. There are telltale signs. Businesses that aren't refreshing their fit out, aren't refreshing their product lines, even simple things like dilapidated storefronts and signage. They all point to companies that don't have that liquidity to invest in their business. But as Ian rightly identified, it's hard to tell the businesses which don't have that liquidity because they're servicing their debt from the businesses that are just taking out profit. I'd be interested to hear how Ian might differentiate. But
well, before we go to Ian, Adrian, can I ask, as an accountant, what from a balance sheet, what is a zombie business?
Well, just to correct any misunderstanding, Brendan, I'm not an accountant.
Sorry, not as an insolvency practitioner then, and a solicitor.
I mean, again, that's not always straightforward because you're very much you're very much beholden to information, and it depends how up to date the information is from people. But you'll be balance sheets that are heavily debt laden compared to the size of the turnover of the business. That's going to be your key indicator. It's the level of debt overall compared to the size of business. And it's affordable, so you're not seeing something that is cash flow insolvent or possibly even balance sheet insolvent. But it can make the payments, but there's nothing really to spare, and it's probably a result that you're probably seeing the key stakeholders from within the business not taking the amount of money that they would hope to take, or so everybody, they're managing everything to be able to continue to exist, but nothing more. So it's just all the accounts which show just a lack of fat in the whole picture.
And I guess we expect all these zombie businesses would have had some sort of government support over the last 9 to 11 months, I suspect.
You've got that, and you've now got the latest announcement, the landlord pushing landlords to enter into arrangements for long-term recovery of accrued rent arrears, to smooth things out on the exit from COVID. I mean, you can see the government's intentions, and you can understand the reasoning from it, because you look at the COVID picture and see all these things that in a very micro world you would say have all come about because of COVID, and you want to make sure that when the restrictions on petitioning and stat demanding fall away, and when the COVID protection for commercial tenants falls away, that business just doesn't drop off the end of a cliff with a huge number of insolvencies. But actually, this position, as you pointed out, has arisen, and it's been there for 8 or 9 years and has steadily increased.
A point you touched on there, Adrian, is this extension that was announced yesterday as well, that the restriction on landlords forfeiting commercial leases is being extended again to March next year. Now that will be 2 years where many tenants would have been looking at it as almost a rent-free period, because they know that the landlords can't take back the lease, can't evict them. So what you will be faced with in March next year, not only these tenants who suddenly have to start paying their rent again as it falls due, the new rent, but they will have this enormous accrued liability for 2 years worth of rent arrears, plus things like the business interruption loan payments that will be due, business rates holidays which are going to start being tapered off shortly. So you've got these businesses which by definition can only just make ends meet, and then on top of that they've got these huge liabilities that they will have to find from somewhere. And I think the reality is that lots of them just won't be able to.
Ian, credit manager's point of view?
Yeah. So for a trade credit manager, I like to think that any decisions we make is based on a combination of things. It's, for me, it's all about risk at the end of the day. Credit to trust, that's the whole point. Can we trust this customer, to pay in 30 days or 60 days or whatever your terms are? The problem we always have, and it's got worse over the years, is the information we have in front of us, or at least the filed information we have in front of us, has got less and less as time goes on. So that's made it harder. Any information you've got is out of date. So, we're looking at accounts, if you're lucky, filed for the year ended somewhere in 2020, if you're lucky. But certainly anybody filing accounts for the first 3 or 4 months of the year, so up to March 2020, really the impact of this whole last 18 months isn't even yet reflected in those accounts. So you're always looking for that extra. So you're working with old information, you're working with whatever else you can glean from that company, business that you're looking at. I'm an old-fashioned credit manager. I will go out and see customers. Sadly, it's not been the case recently, but I'll go out and see customers that where we're looking at large risks, and I'm not comfortable with what I'm looking in front of me. Going back to what Liam was saying before, it's about the frontage. Have they looked after their premises? What are they like? Are they, do they look too good to be true, or not good enough, or so it's good old-fashioned gut feel. Now, I know there's going to be loads of credit managers out there that all go, yeah, well, that's all very well, but when you're handling a ledger full of 2, 3, 4, 8, 10, 20, 30,000 accounts, you can't possibly take that individual approach with that many businesses. You can't, and you have to rely on credit reference agencies and automatic scoring and portfolios, whatever they want to define their different products as, and using their payment performance indicators as well as a sign. But our best, for me, my best risk indicator is the fact that I want my credit controllers who are in that daily contact, they need to be the eyes and ears for me. You cannot beat people actually talking to people, because that's when you get signals, that's when you get messages. And I think there's a general trend in credit to actually push back to more phone work rather than the automation. I think there's a lot of automation behind things that is still driving and supporting that. But certainly this crisis, whole pandemic, Karndean's benefited massively from having a policy of, we want to talk to our customers. So if they haven't paid, we will phone them. That's the first point of call, is to phone them. And I think that's actually paid a lot of dividends for us. And I think other companies have seen that. But it's very, very difficult. It's, for me, it's how, it's making that risk. And you can stick 10 credit managers, and I've done this, 10 credit managers in a room with a set of accounts and say, come up with a credit limit, and they all come up with something different. Because it's not a precise, it's a dark art. It's based on your experience, based on your industry perspectives.
I mean, the next question I've got from the attendees is, how does a credit manager deal with a zombie? If you're dealing with a zombie business, they're a zombie business, but you've got to get paid now for the next 12 months, 24 months. How do you deal with that business, though?
In the same way that they are dealing with themselves, almost, it's hand to mouth. So, if we deem it, we will take a decision on the level of credit that we will offer. That will depend on whether it's credit insured or not. We credit insure, so that makes a difference for us. Not that we're dumping responsibility on the credit insurers by any means, because we still treat it as our own. So it's about setting a level that you actually think is an acceptable risk given their circumstances. And if that risk is actually, we don't want to take a risk, then we don't take it. So it's about setting a limit to which you are comfortable, or as comfortable as you can be. And we get customers where they suddenly have a large opportunity, and we'll say thanks, but we're going to have to look how we work through this. Because I very much like to think that I take a commercial approach to credit. It's not about saying no, it's about how do I say yes, and that's a very different approach. So it's about trying to find a way to help this customer. If a customer's got a good opportunity, we want to be there to support that, but there's only so far you can go. So for me, it's about setting a limit and then reviewing it as you go. There's no more you can do, really.
Ian, just do you ask your customers if they've taken advantage of any of the government loan schemes?
Well, yes, but only as part of discussions that we may have. So, we've not done any sort of ballpark, global, what's the word, large scale questionnaire or anything like that. But no, where we're talking to them about risk decisions that we want to have conversations about, then we take all sorts of questions. How much of their business do they do on credit? Because one of the biggest problems you have, particularly in the likes of the construction sector, is a company goes bust simply because their customer's gone bust, or their customer's gone bust. So, a domino effect. So, we want to know who their large debtors are, how much they are borrowing, how much they have had to use government support in the last. So these are all questions, because these are all post last filed accounts.
Yeah.
So we will ask those questions when we're making big decisions, larger credit decisions, in the current environment. Very much so. Adrian,
I know this is kind of it's a yes answer basically, but have CBILS fueled the return, or have the increase of zombie businesses?
I think it must have, because as we sit here at the moment, people are. I'm not sure whether there's a fixed start repayment. Don't think you pay anything for a year, so there'll be a lot of people sitting there who've had the cash, who haven't yet had to start repaying, and will have to start repaying soon.
I think some of them, the repayments began to fall due this month.
Yeah, I think
because nobody expected a year down the line, last June, to still not have that kind of income to be able to service the loan. But lo and behold, these essentially commercial loans are starting to fall due.
Yeah, and just to add to that, just on the other problem we have is you're looking at a set of accounts where they might have started taking that out, and because a lot, when you're looking at accounts for small companies, there's just no detail. So it might be sitting there as a long-term liability. You have no idea what that is. Not without asking the question.
And I guess this always comes back to the same problem, though, doesn't it? It comes back to, we're now in a scenario where you've got the bounce back loans. The government are unlikely to want to, HMRC have given extensions and all sort of payment plans, another extension this year. So we've got that. We've got CBILS in the marketplace. So HMRC are going to not take any action. The banks aren't going to take any action because they haven't done for how many years now. So who's going to take the action then, Ian? Are the creditors going to take the action? Are the creditors going to spend £2,500 of their own money to, wind up a business? And then but then if the trade creditor doesn't do it, that's where your zombie business comes, isn't it?
Oh, I mean, listen, we have forever seen people owing us smaller amounts, I must admit. But we've over the sort of 6 years I've been at Karndean, and prior to that in other businesses, the amount of companies that literally just cease trade, shut the shop, and just wait to be struck off, frankly. But, and creditors, you're right. Creditors are not going to spend the money when they know damn well there's no asset there. I'd love to be able to liquidate them all and at least get a bad tick on the director's record, but no, it's not possible. And a lot of creditors don't have the appetite. Bear in mind, I'm sure our insolvency practitioner friends will all agree. A lot of creditors don't even bother to fill in the insolvency paperwork and send it back. So that's the problem. There's a shrug of the shoulders, and a name might be written down somewhere to say, look out for him if he resurfaces somewhere, and that's it. You shrug your shoulders and move on. So you're right. There's no appetite, and I doubt there will be in the short term.
I mean, just as an example, it's not a zombie business, but a business with more than 100,000 creditors. We sent the papers out. We've had 500 people have filled it in and replied. And that's 500 is a very high number for an insolvency, but as a percentage of 100,000, it just shows a lack of engagement.
I have to admit, I do mine every time.
But you see, guys, obviously that's my, I work, as we said earlier on, I work pre-appointment with creditors on cases, and there's so many times where creditors fill it in purely because it's me. I say, Brent, I'll fill it in for you, but we don't expect to get anything back from it. And that disengagement, I've seen get worse and worse. I mean, I started insolvency in 1999. And it's got worse from creditors every year. The bigger guys will always do it. The big construction firms I work for, some of the big landlords, some of the big utility companies, they'll all fill it in. But the normal trade creditors is like, great, what am I going to get back from this? 0.08p in a pound or whatever it is, an unsecured creditor. We're kind of going off the point a little bit, but the problem is with the zombie business, it's quite simple. They're existing because no one knows what to do with them. And C-bills has just caused a new, I think COVID has just caused. Yeah, sorry.
I was just going to say, Brendan, a really good example, I think, is the work I do on a day-to-day basis for landlord clients. So typically, pre-pandemic, they've got tenants that aren't paying their rent. There's no dispute over it. It's a contractual debt, and typically they would go straight to serving a statutory demand, and then either threatening or seeing through a compulsory liquidation. Now, obviously, with the government's restrictions in like the pandemic, that option is off the table. So, really, the whole exercise now is trying to weed out the can't pays from the won't pays. And the only real mechanism that landlords have got to do that now is just an old-fashioned county court money claim, which arguably is slightly toothless because you go through that process and you get your judgment. And the way you would typically then enforce that is, lo and behold, to threaten insolvency. But it's there are still businesses out there that don't want those CCJs on their records, on their credit files, and they will be responsive when threatened with a claim or when a claim is issued. They have different thoughts on when to actually engage in that process to try and reach a settlement. But without wanting it to sound like a shameless plug, if credit managers and controllers out there have good relationships with solicitors, it can be a really cheap and effective and useful way. If you've tried every option yourself, trying to maintain that relationship, because you do have to be sensitive of how it might affect the trading relationship going forward. But if you've tried everything, there are actually quite sensitive ways for a solicitor's letter to say, look, we have tried, you have left us with no option. We still don't really want to do this. So talk to us, and dialogue really is key. I am invariably instructed by landlords to issue these claims only where their tenants have gone radio silent on them, and they've got stakeholders, they've got other outside pressures that they need to satisfy, and they really come to me and say, we have to be seen to be doing something. So if you can maintain that dialogue, and as long as things are moving positively, then of course you don't want to have to take that step. But if left with no other option, it can be really effective.
On that basis, guys, property, I'm not sure, Liam, but what are the main sectors that we find zombie? I know when I did a session on this last week, my other partner Ian Defty said construction is probably the biggest one for zombie businesses. Adrian, is there a certain sector that you find more zombie business than others?
It's really difficult to say. With Okay, I mean, I see. Naturally, I would have thought the construction wasn't, because there's probably more volatility in supply side on that in that sector, particularly at the moment. Naturally, you would think, I suppose, hospitality, simply because they've been closed, employees on furlough, but then you look at that in a slightly different way. You go and try and stay in a hotel for 2 nights in England sometime in the next 6 months, and you can't get in anywhere now. So again, that sector's turned completely on its head. I don't think it's easy to identify the sectors, because I think there'll be a lot of variation within the sectors as to the businesses in there and how they've managed themselves through the pandemic, and what sort of situation they were in before that.
Liam,
Sure,
is property one?
So I was going to say, I'm not too sure historically, going back 5-6 years, what the which sectors were most susceptible to zombie status. But I do know that this new breed that we're talking about, the ones that have probably been most reliant on government support, are things like obviously things like retail, leisure, hospitality, also things like arts and entertainment. I read something that there was about a 10-fold increase in the number of zombie companies in the arts and entertainment sector. And conversely, there are other sectors that haven't been as impacted, haven't been quite as reliant on those support measures like IT and logistics. So I think you can certainly identify which ones now you would be most concerned with.
But also, you mentioned retail, Ian, Liam. It's retail again. That would depend very much on how reactive you were to what happened, because a lot of retail people just diversified completely. You got some small pubs that shut, and some small pubs that said, well, hang on a second, we'll do food on a Friday and a Saturday every week, takeaway, 5-minute slots. And they do a week's worth of, they're making more money doing that than they were when they were a village pub. So, and
there'll be retailers that have a really robust online offering,
absolutely.
And others, Poundland, Primark, that's just never been part of their model. So for good or for bad, they are probably feeling the effects more than some of their competitors. So yes, even within retail, there will be different red flags.
Yeah, I think, sorry, just following up on the comments around construction as well. I mean, obviously we cross into the construction sector. The construction sector generally at the moment is actually incredibly buoyant, driven by a lot of infrastructure projects, a lot of building work. Conversely, the construction sector has always historically had issues with rates of insolvency, bankruptcies, etc. So, Karndean, along with a lot of people in the construction sector at the moment, is riding the wave of a lot of spare cash in the UK's pockets that is being invested either in extensions, house builds, and all that sort of stuff. So I think the construction sector is quite buoyant, and there are lots of opportunities there for companies and for zombie companies in the construction sector to actually get themselves out of it. The key issue for me is about the management of those companies, and it's down to whether they have the appetite for it, the drive for it, the honesty for it. Because again, you can look at the construction sector again and say, well, and credit managers will tell you, trade credit managers will tell you about their industry, the drinks trade that I used to work in. There's plenty of not too honest gentlemen out there who will take the opportunities. So, I think a lot of it will depend on the management of those businesses and how they find their way out. Because I think a lot of them, if they've got the opportunities, will take those opportunities and get themselves out of it.
There's a couple of statistics that I'll just point out. So we, as in Begbies, did some research about first quarter of this year. and that was at 723,000 businesses were in some sort of distress and faced some sort of process, not insolvency, but some sort of process within the next 10 to 12 months. The other statistic that was quite interesting from a government report was that there was 12% of zombie businesses throughout the whole country before COVID, and they believe that's increased to 16%. So that's quite a strange. It's strange that the number's only gone up by 4%. Now, I haven't got the total number of businesses in the UK, but that's still, I'm presuming, a huge number. So, you know, there is definitely change. I think, Ian, you're right. Theory, I just had a quick look at an article here that, you know, construction is thriving. I think that kind of makes sense, actually. But hospitality is one that had the real kind of had a bit of a punch, basically. But I think it's going to be a difficult 12 months for all businesses. I've got a question from one of the attendees. This is for you, Liam. So let me just read this to you. Okay, Liam. What sort of cost savings could be realised if a commercial landlord solicitors could identify can, can't, won't pay us early in a bad debt cycle? So what sort of cost saving can be realised if a commercial landlord solicitor could identify a can, can't, or won't pay earlier in a bad debt cycle?
Yeah, it's a good question, and the answer is, I think, considerable costs, because, you know, everyone knows litigation isn't cheap. Even if you're successful, you know, the usual rule is if you're successful, you get your costs paid by the other side, but it's never 100% recovery. Something around 65% might be common. So there's a cost to you, even if you're successful, and even if you end up enforcing and recovering the debt that you claim through the process. So it's a really important part of the exercise we go through early on. You know, we're looking at the individual debtor, you know, whether it's an individual or a business, if there are any guarantors. You know, typically I'll be looking at lease debt, rent arrears, or service charges. So we look at all the options. We don't just look at that individual debtor. We look at the previous tenant, if they are still liable, if there's a guarantor. If it's an individual, you know, we'll run credit checks, because it's a real Pyrrhic victory to go through that process, foot all of those costs, and ultimately come away with something that you can't enforce because there are no assets. So yeah, I think the answer is a lot of cost, and it's not something that you should enter into lightly. But if you sit down, it's a small investment up front of time, a couple of hours with your solicitor, with your credit controllers, just have a look through the documents, see what your options are. You might decide to pursue a different, someone else who's on the hook. And sometimes the best answer is just to let it go, because it's you're just throwing good money after bad.
Thanks, Liam. Okay, next question. We're running out of time here. So, what else can banks, creditors, and the government do to stop the creation of new zombie businesses? I mean, I think we kind of touched on this earlier. Is, you know, everyone's looking at each other, aren't they?
Yeah, it's slightly after the horse has bolted, isn't it? Really, given what's happened over the last 15 months or so, I think the issue will probably be dealing with this new generation of zombie businesses that has been created. And you know, Adrian touched on earlier the announcement yesterday that again, not to limit things too heavily to the landlord and tenant relationship, but there will be this. It will be written into legislation that landlords and tenants will have to enter into arbitration. It will be required of them to enter into arbitration over these arrears that have accrued. And I think the expectation there is that those debts will be ring fenced for a period, so landlords won't be able to enforce them until that arbitration process has been seen through. But in terms of how you prevent new zombie businesses, where there's such access to cheap money, you know, in this low interest environment we've got, it's impossible, because how do you discourage people from you know, taking that cash in?
it's a bit like saying how do you stop bad directors? How do you stop bad directors or who've got multiple liquidations behind them from setting up a new company and starting again? It's a question that's been asked for years amongst trade credit managers. I'm not sure there's a simple answer or an answer at all. Maybe.
I think the economy will probably regulate itself to an extent. Once interest rates go up, when there's less access to cheap cash, it's probably just a byproduct of the market we have.
I think you're right. I think the impact of COVID in terms of personal finance, where the statistics, March last year net saving was 4 billion. March this year net saving was 16 billion by individuals, and that's meant there is a lot more cash out there. There's and a lot more inflationary pressure, and I think it's the inflationary pressure and managing interest rates is the only thing really that's going to have any serious impact on this.
And Adrian, is that something we think will happen in the next 2 years, 3 years? Do we see an enough increase where all of a sudden zombie businesses will scratch their heads and go away?
It could do. I can see. I mean, just looking at construction, construction's suffering a bit of a perfect storm, as I understand it, at the moment. So you've got a whole raft of issues. You've got a load of cash in the economy so individuals paying for extensions and building work. You've had the fallout from Australian bushfires, which has wiped out most of the Australian supply of commercial timber, which has meant supply is much tougher globally. There are major issues in the polymer sector in Texas and the surrounding states that have meant that materials that have particular types of polymer in them are also very, very under pressure and very scarce because of issues there. So you've got more cash and more purchase power, but less supply. So you go to, I know from personal experience, you turn up at Jewson's and there's just a poster up at the front gate that just says no cement, no concrete, no post mix, no 2x4 timber, and all of those things are creating upward price pressure. So I think it is going to come. It's been around for so long, these low interest rates. It can't continue to stay at that level with prices increasing.
I mean, just to give you just a quick stat, if it's worth it, levels of insolvencies across our customer base this year are 25% what they were the previous 2 years. So customers, our account customers who have gone into insolvency this year compared to the previous 2 years, partly because they've been propped up, partly because they're, I am sitting in my board reports every month and saying, it ain't going to stay like this, folks. It is going to happen. It is going to happen. I feel like the prophet of doom, but and he's not coming. I feel like he is coming. It'll be soon. It'll be soon. And I think you're right. It's got to happen sooner or later. But it's just a question of when.
I think that figure is representative across the country as well, Ian. I remember reading that insolvencies for 2020 were about 27 or 28% lower than the previous year. And interestingly, all types of insolvency had reduced. So CVAs were at historic lows. Compulsory liquidations obviously were at historic lows because. I mean,
you only have to see just as an example. You look at a fixed price building contract. Fixed price building contract, and steel went up 4 times in May. So someone's got to take the cost somewhere, and it's going to be the building companies and and people in the construction sector that take it.
I mean, to put it very simply, the reason for there being 27 or 28% less insolvencies isn't because businesses are doing so much better than in previous years. It's it will have to come to a head.
Okay, final question, and I'll let Colin in. I'm going to aim this at you, Ian, so apologies. The final question for the day is, moving forward, what advice can you give your business, credit managers, FDs, to protect their business against zombie businesses? Ian?
Two things that spring to mind specifically. One, know your customer. The more you know, the more you stay in touch, the more you have that interaction, the better chance you've got of picking up the signs. And secondly, be confident in credit insurance as well. I mean, we credit insure. It's helped us immensely having that additional support, both in terms of collections, risk management, particularly at the heavier end in terms of large scale limits. Be prepared to back credit insurance. It's helped us immensely in the last few years, and something that the business now recognises. So just a couple of things that spring to mind there.
Thank you, Ian. Guys, I think I'm going to wrap up there. We're just slightly over. Colin, I'll head back to you, but thank you.
Thanks, Brendan. No, it's really, excuse me, very good. Really interesting to hear those different views from the different parts of the process, I guess, in terms of identifying these companies and what we can do about them. It's obviously a key issue. We've done a bit of a survey, which we'll cover off in the. It's quite divided in terms of people's perception of the amount of zombie companies they've dealt with. So that would be. We'll share that on the Credit Connect review next week on our website about that results, because it's quite an interesting breakdown and people's perception of what kind of companies are in there. But yeah, no, let me round up by saying, obviously, thanks to our panel. Really good to hear their opinions. So Liam, Ian and Adrian, thank you so much for your insight. And Brendan, for working hard on his second chairing of the day. It's been really good, really interesting. We're going to have what we've called a lunch break until from now, when I finish this up, until 1:05, and on our final session of this Commercial Credit and Collections Conference, we're going to cover technology and credit management. We've got a busy panel on that one. We've got 4 or 5 panelists on there, so that's going to be a lively discussion. You can sign up to that by clicking on our agenda here and click on the link, and that will take you to sign up for that. But for now, let me round up and finish off by saying thank you to everybody who's tuned in, and hopefully we'll see you all again soon. Thanks a lot, everyone. Cheers. Bye.
Thanks, guys.
Bye. Bye.